Hey, what's up YouTube? It's Todd Horst here with Tasty Tracker. Yes, I'm filming this in the dark because why not? Anyway, so today I'm going to talk about what I'm going to do after the 10K, and really this is more of a discussion on different account sizes in disguise. Anyway, so I'm doing the 10K challenge, and some people ask, well, why would you not continue? And the answer is obviously I am going to continue. First of all, I said many times this isn't my only account. So I'm going to take the money out of the 10K and start over again with 1 or 2K, I'm not sure. And then I'll take the 8 or 9K out, and I'll probably do a challenged 25K because that's the PDT cutoff, so a lot of people want to get there. Or I might dump some of the money into just my personal IRA or other margin account. I'm not sure yet exactly, but I do intend on doing the 2 to 10K challenge again and again and again, so that people can follow along. Like I said before, I have several other accounts that I'll just use that money towards. But really the difference is that when you get up to the 8 or 10K mark, the strategies you use change a little bit. I'm basically doing the same thing. The premise is the same, but because it's sort of the next bracket, things change accordingly. So what does that actually look like for me? I'm sure everybody's different, but I tend to do worse entries. That's not on purpose, but if I am feeling in the mood to make a couple trades, then I'll go ahead and put some on, whether the timing is exactly right or not. Some of that's me being lazy or anxious to make a move, and some of it is me speculating on where things are going to go. If I was going to be more conservative, like you have to be with a smaller account, then you don't want to take as much risk by speculating. You want to be more certain with the moves. But with 8 or 10K, you can have a little bit more in reserve. And so if things do move against you, you can always deploy more capital to strengthen that position or to hedge or whatever to offset that position. So you can do a variety of things. So say, for example, I had a bullish put spread that I sold, and then I'm expecting the market to go up and it drops. I can either switch that into an iron condor, I can hedge it with some SPY or TLT positions or VIX positions, or I can double down sort of and go with a lower put spread, sell another lower put spread, so that way I have 2 put spreads, which is actually what I do a lot of the time. If it goes against me, I'll just a couple strikes down, sell another put spread, anticipating the bounce. Okay. Another thing that it differs between my smaller and larger account is I take riskier entries, so they're either at the money or in the money, strike or 2 or 3. And if I give myself enough time, I'm looking for those to still degrade in value enough that I can get the 50% out of it. And if I'm really bullish or bearish, depending on the position I have on that stock, then I am confident that they'll go up that far. The next one is a lower target ROI. So that what I'm saying there is for the entire account size, for the $2,000 account, I have, we'll say 50 to 75. I might go as high as 90 or 95% of my capital deployed because I really don't have that much to begin with. So in order to capitalize on opportunities, you have to sometimes break the rules and go a little bit more all in, and that does put you at a larger chance of blowing up the account. On a larger account, since I don't want to blow it up, I'm going to have, in a sense, a less aggressive stance where I'm not trying to make 40 or 50% on that account each month. I'm only looking to get 10 to 20%. If I got 40, that's fine, obviously, and I have, but that's not necessarily my goal. And so I'll keep 50% of my capital in reserves. So of that, say 8 to 10, I'll keep 4 or 5K not uninvested, just sitting there in cash and waiting for a good opportunity. That's sort of the benefit of options. Obviously, you've talked about this before as well, where you don't need to deploy all your capital, and you shouldn't under normal circumstances, because that's a good way to blow up your account. Because if the market moves against you, as it has recently, then with a smaller account, with all of it all your capital deployed, you're in a terrible position now, and the market has to recover back to what it was in order for you to realize your gains. So it is good to keep 50%, and I'll do that on a larger account. Next bullet point here is hedging. So in my larger account, I don't really hedge specific individual positions, but I definitely have hedges on my account larger. So I have some SPY positions, TLT positions, and VIX. That's basically what I'm doing now. Of course, if you have any ideas for hedging, I'm definitely looking for strategies to make my hedging more robust, but at the moment that's what I'm doing. So I might do some bullish positions on TLT and bullish positions on VIX, and then some small bear positions on SPY. And so the hedging is less aggressive because you're sort of okay with losing that money that you hedge. Obviously, if you can do a hedge that comes out sort of neutral, or even if you can get a small win, that's great. But a lot of times losing on your hedge is acceptable, because that's part of the strategy to protect your account, the larger account. So that's less aggressive. I don't do any hedging on the smaller account because there is just not enough money there to waste on a hedge, and it's really hard. TLT calls are recently have been pretty good. So even if the market's going up, TLT has still been going up because people are expecting and have been expecting a downturn. And if the market's going down, TLT is definitely going up. So selling some puts on or buying calls on TLT has been good for the past couple months, but that's not always the case. Another last bullet point here is that with a larger account, you can let some runners. So you might have 4 positions, or you might have sold, say, 4 spreads for Amazon, we'll say. And you hit your profit target, so you close out 2 of those. In a small account, you first of all can only do 1 spread, and so once that hits the profit target, you close it out. I spelled aggressive wrong there. But on a larger account, you can do 4 and close out maybe 2 or 3 and let 1 running. So that is a more aggressive tactic. The last one could end up backfiring and you lose some of your gains, but the idea is you would move your stop loss so you don't give back all of your gains. But chances are, since it's moving in your favor, you'll end up capitalizing more on that move than what you can on a smaller account, because on a smaller account you want to be conservative and take your position off the table. So just generally speaking, I can sum it up in one sentence, and it would be painful to lose 2K, but losing 15K is a really bad day. It's not something I'm interested in doing. I know a lot of the Wall Street Bet people are doing that every day. I don't have that much money that I'm willing to just throw that away. But real quick note here, I did want to say that I I got it's like an alpha version of the alerts on my website now. So if you want to go ahead and check that out, the free demo has access to that. I will be locking that down more. It's certainly far from finished, but you can see the trades in my small account, and so you'll be able to keep up with any changes. If you just refresh that once or twice a day, you'll be able to see any changes that occur during that day. Anyway, that's really it for today. I don't have a lot to talk about. As always, I have the broker links in the description. Go ahead and like this if you could. That really helps out, and comment. I do have a bunch of videos planned for the next year, and my website's Stacy Tracker, which you know by now. It's $9.99 a month, and I'm always looking to improve that. So if you have any feature ideas you want to have added that would make your process easier, let me know, and I'll see how that can fit in. And then, as always, I'm not a financial advisor. So thanks. Have a good day.